Good news now. Asian stocks were steady with US and European equity futures rising as traders weighed economic risk from the Omicron virus variant as well as tighter central bank policies to fight inflation. European stocks, meanwhile, rose as attention shifted from the Omicron COVID variant to monetary policy decisions by some of the world's largest central banks. It's set to be an important week for monetary policy with the US Federal Reserve, the Bank of Japan, the Bank of England and the European Central Bank all due to make decisions this week. US stock futures rose early after the S&P 500 notched its biggest week, or rather best week, since February at a fresh record close. To talk to us about the latest market developments, we are joined by Gary Booysen from Rand Swiss. Gary, thank you so much for your time. I'm assuming here, before we even get into the markets conversation, that you're still stuck in Switzerland.
Yeah, you are correct. Hopefully back before 2022.
All right. Well, before we even get into what to expect for 2022, how, when you look at the JSE markets, given the background and what I've just described in my opening intro, how the market's faring so far?
Yes, the markets are pretty positive today. And I think it's in part because of that very, very strong S&P 500 we saw towards the end of the week last week. It was a volatile week, but S&P 500 closed up almost 1% on Friday. We've seen the positivity feeding into Asian markets this morning. That's pushed our all-share index up just over 0.5%. It's really being led by the resource companies. You've got the likes of Kumba up over 3%. The Resi index is up over 1%. Finny is flat, so financials not doing too much. India up about 0.5%. So really the resource gain, and I think some of this just coming from I think a little bit of optimism around inflation matching expectations, the US inflation numbers matching expectations on Friday. And as you said, a huge week for central banks this week, with all eyes, I think, going to be on the Fed and its decision on how fast it's looking to taper and then start to increase interest rates.
On the back of that, I mean, how sure are we about, the Fed? Because at some point, some people are saying, well, Fed Chairman Jerome Powell will have to move a lot quicker than he even expects. And the question is, can he do it in such a way in that he doesn't, wreck things too much or, jolt the cart a little bit?
No, absolutely. So if you look at the expectations around inflation, so if you look at the consensus expectations by all the big bank economists, it does seem that they believe inflation is going to be brought under control fairly quickly. The Fed has a very similar view. As I said, the inflation on Friday, yes, it was in line with expectations, but consumer price inflation in the US at 6.8%. That puts their real interest rates deeply negative. And, I get the sense that we are going to see a fairly aggressive taper. The fact that tapering is coming is now a foregone conclusion. The guidance is that we're going to see tapering completed by the middle of 2022, and it's really going to be about how far interest rates can rise in the US. The problem is that if you look at the yield curve, so you look at the shorter dated interest rates versus the longer dated interest rates, it's kind of pricing that we're going to get this initial bump up in interest rates, but then the Fed is going to be very limited in what it can do, further down the road, just because of the size of US debt and many other, the amount of pressure that it will put on the economy that is very indebted. So I think it's going to be an interesting Fed announcement to watch. And after the last FOMC meeting, we got the sense that it took the markets a little bit by surprise, but with the hawkish tone, we saw a little bit of volatility creeping in, and it's all going to be what to watch towards the end of the week. If the market seems to be pricing a more optimistic meeting, but I don't know if we're going to get it.
All right, so locally on SENS, we had Shoprite Checkers announcing that they've entered into a joint venture with logistics company RTT Group, and that will result in the retailer owning a 50% stake in a new online delivery company. This whole delivery side of the business seems to be the new game in town, and I've noticed on your social media, you're running a poll where you're trying to ascertain, which people, where people actually would rather thinking they might actually get the best customer experience. Is it Checkers 60/60, Pick and Pay ASAP, or Woolies Dash? And 63 votes in, it seems to be, Checkers 60/60. What do you make of what's going on in this game?
Yeah, surprised so far. Okay, as you say, only 63 people voted so far. We've just put up the poll, but it's taken 60-60 seeming to win it by a landslide. And part of the deal that we're seeing today, the transaction that Shoprite's going through, so Shoprite, obviously the owner of Checkers, is really about protecting its IP and controlling that what we call the last mile. So essentially the delivery aspect of being a grocer. So in the past, being a Pick and Pay or a Shoprite or Woolies, it was all about what products do you have on the shelf. And yes, it was always incredibly important to get those products into the stores. The logistical aspect, your supply chain management was a key differentiator. But in 2021, moving into 2022, what really is going to become key is what you can do in that last mile. People don't want to have to drive to shops anymore. They want food delivered straight to their homes. And having the right technology and the right customer experience is going to be incredibly important. And part of this deal that Shoprite has done, they've worked with RTT to expand that delivery network. And it seems to be working, because if that Twitter poll is anything to go by, it does seem like Shoprite 60-60, at least Checkers 60-60. It's a long way ahead of the competitors, with Woolies Dash and Pick and Pay ASAP, just lagging a little bit behind in the customer experience.
Right. As we, I suppose, wrap up the year and go into 2022, I want to get back to that whole Fed conversation we're having around, interest rates. I mean, some people saying we should get used to higher inflation, probably not 6.8%, but significantly higher. On the back of those comments, I mean, what does that mean for an investor? How do you position your portfolio in that environment?
So it's a very good question. So if you look at it, naturally what happens when you have higher interest rates, your cost of capital, so the price of money is increasing. That means that if you want to start a project, you want to start a new business, you want to, any businesses that are very indebted suddenly have a much higher bill to pay when it comes to borrowing money. That generally suppresses the economy, and it is bad for stock markets, but it's not necessarily always bad. If you look at the history behind what happens in a rising interest rate environment versus the stock market, you quite often see that stock markets still run hard in rising interest rate environments, but it's a very different segment of the market that runs. The typical growth stocks, where we've seen incredible movements over the last couple of years, if you look at in the international market, the likes of Google and Facebook and now called Meta and Apple and all those big tech companies have done exceptionally well. On the local market as well, it's been things like Naspers that have really driven the performance on the JSE. What happens in a higher interest rate environment, you get a shift away from what you call growth stocks into more value-orientated stocks. So it's the more traditional companies that have much lower PE, so they're much lower earnings multiples, they're a lot cheaper, but they generate money now. So you can think of that more as the likes of things like British American Tobacco or something like General Motors or Ford, which are generally they produce a lot of cars. They earn their money now, but they don't have this kind of growth story where they're going to essentially earn money in the future. That shift is likely to happen. So it's not that markets are going to stop running because we have high interest rates, but the sector of the market that you invest in is going to be very, very different if we have persistently high inflation and therefore persistently higher interest rates.
All right, Gary, thank you so much for your time. That is Gary Booysen from Rand Swiss. We're going to take a quick break, and when we come back, my colleague Nompumelelo Siziba will be with you until 3 p.m. And it's a goodbye for me.